Become Money: How to Make Money Work for You, audiobook. Written by Ethan Hope, published by Wisdom Audiobooks. Introduction. Picture this. It's the end of the month, and you find yourself scrambling to make ends meet, wondering where all your hard-earned money went. What if you had the tools to change that narrative, empowering you to take control of your financial destiny? Imagine the feeling of relief and empowerment as you log into your bank account and see a healthy balance, knowing exactly how you got there and how you're going to maintain it. This book aims to equip you with those tools, regardless of whether you're a young professional just starting out, someone in midlife planning for retirement, or anyone grappling with financial anxiety and burdensome debt. Your relationship with money starts in your mind. Imagine shifting from a mindset focused on scarcity, where every expense feels like a burden, to one of abundance, where you see opportunities for growth and wealth creation instead. The idea that the biggest hurdle to financial success is often our own mindset may sound surprising at first. We are conditioned to believe that earning more money is the only solution to financial problems. However, without the right mindset, even the highest salary can quickly be whittled away by poor financial habits and anxiety-driven decisions. By transforming your perspective on money, you can begin to pave the way for lasting financial stability and growth. What if you could wake up each day knowing that the money you earned is now working tirelessly for you, generating income while you focus on the things you love? That's the power of financial freedom, and it starts here. The concept of making your money work for you might seem daunting at first. You may wonder if it's possible given your current circumstances. Rest assured, the strategies outlined in this book are designed to be accessible and actionable for everyone. Whether you're looking to budget better, invest wisely, or simply alleviate the stress of overwhelming debt, these techniques can set you on the path to making smarter financial choices. Throughout this journey, you will hear stories from individuals who transformed their financial lives through strategies that may seem simple, yet are profoundly impactful. One listener turned a side hustle into a six-figure income, proving that dramatic change is possible. These real-world examples serve not only as inspiration, but also as practical case studies to show you how these principles can be applied. You'll learn from people who started out facing similar financial challenges and went on to achieve remarkable success. In today's fast-paced world, financial literacy has never been more crucial. Young professionals, in particular, face the challenge of navigating complex financial landscapes while trying to establish themselves in their careers. With student loan debts, housing costs, and everyday expenses mounting, it's easy to feel overwhelmed. Yet this stage of life offers a unique opportunity to lay down a solid financial foundation. By adopting smart budgeting practices, understanding investment options, and cultivating a positive money mindset early on, you can set the course for long-term financial health and success. For individuals in their midlife concerned about retirement planning, the stakes feel even higher. With the future approaching faster than ever, ensuring a secure financial footing becomes paramount. Many find themselves at a crossroads, unsure if they have saved enough or invested wisely to support their retirement years. The actionable steps provided in these pages aim to demystify retirement planning, offering clear and achievable paths to bolster your financial security. It's never too late to make effective changes. Even small adjustments in spending, saving, and investing can yield significant benefits over time. Anyone dealing with financial anxiety or overwhelming debt knows how paralyzing it can be. The weight of unpaid bills and the constant worry about making ends meet can take a toll on both mental and physical health. Achieving financial literacy is a powerful antidote to this stress. By learning how to manage debt, create a realistic budget, and develop a plan for financial recovery, you can regain control over your finances, and by extension, your life. This book provides you with a roadmap to navigate out of the fog of financial confusion and into the clarity of financial confidence. Our approach is holistic, focusing on both the psychological and practical aspects of managing money. It's not just about cutting costs and maximizing savings, though those are important components. It's about creating a sustainable and enriching relationship with your finances that supports your overall well-being. Financial empowerment comes from education, mindful decision-making, and proactive planning. By the end of this book, you will be equipped not just with knowledge, but with the confidence to apply that knowledge effectively. As we delve deeper into the topics of budgeting, investing, and wealth creation, you'll come across methodologies that are straightforward yet robust. We break down complex concepts into digestible, actionable advice that you can implement immediately. Whether it's mastering the basics of budgeting, exploring different investment vehicles, or understanding the nuances of credits and loans, each chapter is designed to build upon the previous ones, gradually expanding your financial toolkit. The journey ahead is transformative. By embracing the principles laid out in this book, you commit to reshaping your financial future. The scenarios and strategies discussed are not distant dreams, but attainable goals. Let these pages guide you to financial awareness, literacy, and ultimately, freedom. Your future self will thank you. So, take a deep breath and prepare to embark on this journey. Whether you're just starting or looking to refine your financial strategies, this book is your companion to a brighter and more secure financial future. Welcome aboard. Chapter 1. Understanding Your Money Mindset. Understanding your money mindset is essential in shaping your financial future. Many of us hold ingrained beliefs about money that limit our potential for financial growth. These beliefs, often stemming from childhood experiences or societal conditioning, can significantly impact our ability to manage and accumulate wealth effectively. By recognizing these limiting thoughts, we can begin to shift our perspectives and cultivate a more positive and abundant mindset. In this chapter, we will delve into the identification and origins of common limiting beliefs about money. We will explore how these beliefs manifest in everyday financial decisions and behaviors. Additionally, we will provide practical guidance on how to challenge and reframe these negative narratives through reflective journaling and other techniques. By understanding and transforming your money mindset, you can unlock new financial opportunities and create a foundation for lasting financial success. Identifying limiting beliefs about money. Understanding your money mindset is crucial on the journey toward financial well-being. Many of us unknowingly harbor limiting beliefs about money that can hinder our ability to achieve financial success. Recognizing these beliefs and understanding their origins is a fundamental step in transforming our mindset and fostering an abundance mentality. Common limiting beliefs about money often revolve around negative connotations and a sense of scarcity. Two prevalent beliefs include, "Money is the root of all evil," and "I will never have enough money." The idea that money is inherently evil may stem from misinterpretations of cultural or religious teachings. For example, the saying, "The love of money is the root of all evil," 1 Timothy 6:10, is frequently misquoted as, "Money is the root of all evil," leading to a belief that pursuing wealth is morally wrong. This misconception can result in guilt and anxiety about seeking financial prosperity. The belief that one will never have enough money is another common form of scarcity thinking. This mindset can lead to chronic financial stress and poor financial decisions, such as avoiding investments or missing out on opportunities for growth. It fosters a sense of hopelessness and resignation, making it difficult to break free from financial struggles. Understanding the origins of these limiting beliefs is essential for overcoming them. Childhood experiences and societal conditioning play significant roles in shaping our views on wealth. For instance, growing up in a household where financial struggle was prevalent can instill a deep-seated belief that money is always scarce. Similarly, societal narratives that equate wealth with greed can reinforce the notion that aspiring for financial success is undesirable. Children absorb and internalize the attitudes of their parents and caregivers regarding money. If parents constantly express worry over finances or criticize the wealthy, these attitudes are likely to take root in the child's subconscious mind. Societal conditioning also comes from media portrayals, educational systems, and peer interactions. Stories of corrupt billionaires, sensationalized news about financial scandals, and cultural myths about the virtue of poverty further embed these limiting beliefs. To counteract these deeply ingrained beliefs, personal reflection exercises can be incredibly helpful. Reflective journaling, for instance, is a powerful tool to explore one's belief systems about money. By writing down the thoughts, feelings, and memories associated with money, individuals can begin to identify patterns and origins of their limiting beliefs. Journaling prompts could include questions like, "What did my parents teach me about money?" Or, "What do I fear most about wealth?" This practice brings awareness to subconscious beliefs and provides clarity on how they influence current financial behaviors. Reflective journaling allows individuals to challenge false narratives and replace them with empowering beliefs. For example, someone who believes money is the root of all evil can reframe this thought by recognizing that money is a neutral tool that amplifies one's intentions. Instead, they might adopt a new belief such as, "Money gives me the power to create positive change." Similarly, the belief "I will never have enough money" can be transformed into, "I attract opportunities that lead to financial abundance." Recognizing and challenging limiting beliefs not only helps in reframing individual perspectives, but also opens doors to financial opportunities that were previously unseen or undervalued. This shift from a scarcity mindset to an abundance mindset creates a more positive, proactive approach to financial management. In addition to reflective journaling, engaging with supportive communities and seeking positive influences can aid in this transition. Surrounding oneself with individuals who have healthy relationships with money, attending personal finance seminars, and consuming content that promotes financial literacy can reinforce new, empowering beliefs. These actions encourage continuous learning and provide examples of how others have successfully navigated their financial journeys. It's important to remember that changing one's mindset is a gradual process, requiring patience and persistence. As individuals continue to recognize and challenge their limiting beliefs, they will find themselves more capable of making sound financial decisions and achieving their financial goals. Cultivating an abundance mindset and positive financial affirmations. An abundance mindset is the belief that there are enough resources and opportunities for everyone. This perspective allows individuals to view challenges as opportunities, embrace gratitude, and stay open to new possibilities. On the contrary, a scarcity mentality focuses on limitations, fostering fear, competition, and anxiety about not having enough. Understanding the difference between these two mentalities is the first step toward shifting towards an abundance mindset. Visualization techniques can be powerful tools in cultivating an abundance mindset. Visualization involves imagining and mentally experiencing your desired outcome. For financial success, this could mean visualizing yourself achieving your financial goals, such as paying off debts, investing wisely, or enjoying financial freedom. Regularly visualizing these scenarios helps reinforce positive thinking and build confidence in your ability to achieve them. Here's how you can get started with visualization. Find a quiet space. Choose a peaceful environment where you won't be disturbed. Set clear goals. Know precisely what you want to achieve financially. Create vivid images. Picture the details of your desired financial situation, including the sights, sounds, and emotions associated with it. Repeat often. Make visualization a daily practice to strengthen your mental connection to your financial goals. Building relationships with individuals who have a positive money mindset can significantly impact your ability to develop an abundance mentality. Being surrounded by people who view money positively and recognize opportunities rather than obstacles can inspire you. These relationships offer support, advice, and encouragement. Here are some ways to build such relationships. Seek out mentors. Look for individuals who have achieved financial success and learn from their experiences. Join financial communities. Participate in groups or forums focused on financial literacy and growth. Network actively. Attend seminars, workshops, or social events where you can meet like-minded individuals. Foster positive relationships. Cultivate friendships with those who celebrate your successes and encourage your growth. Creating effective financial affirmations is another essential step in developing an abundance mindset. Affirmations are positive statements that you repeat regularly to reinforce your belief in your financial success. To write effective affirmations, consider the following guidelines. Be specific. Tailor affirmations to your individual financial goals. Instead of saying, "I am wealthy," say, "I am steadily increasing my savings every month." Use present tense. Phrase affirmations as if they are already happening. For example, "I am attracting lucrative opportunities now." Stay positive. Focus on what you want to achieve, not what you want to avoid. Say, "I am thriving financially," instead of, "I am not struggling." Keep them simple. Make affirmations short and easy to remember. This makes it easier to incorporate them into your daily routine. Incorporating affirmations into your daily life is crucial for their effectiveness. Consistency is key. Here are some strategies to help integrate affirmations seamlessly. Morning routine. Start your day with affirmations to set a positive tone. Write them down. Keep a journal and write your affirmations daily. Visual cues. Place sticky notes with affirmations around your home or workspace. Meditation. Combine affirmations with meditation sessions for deeper impact. Verbal repetition. Speak your affirmations aloud multiple times a day. Affirmation. Apps. Use mobile apps designed to remind you to repeat your affirmations. The practice of regular affirmations can gradually reshape your beliefs and attitudes about money. As you consistently affirm positive financial outcomes, you'll start noticing shifts in your behavior and mindset. Over time, this can lead to real changes in your financial situation. For young professionals looking to establish a solid financial foundation, adopting an abundance mindset early in their careers can lead to more significant opportunities and growth. It encourages proactive budgeting, investing, and exploring various income streams without fear. By visualizing success and surrounding themselves with financially positive influences, they can stay motivated and focused on long-term goals. Midlife individuals concerned about retirement planning can benefit immensely from these practices. Affirmations and visualization can alleviate financial anxiety and foster confidence in their ability to create a secure future. Building supportive relationships and engaging with communities focused on financial wellness can provide valuable insights and encouragement. Those struggling with financial anxiety or overwhelming debt can find solace in shifting their mindset. Affirmations promote a sense of control and possibility, reducing stress and encouraging constructive action. Visualization helps keep the focus on achievable goals, while positive influences can transform negative perceptions about money into empowering beliefs. Shifting from a scarcity mindset to an abundance mindset requires consistent effort and mindfulness about our thoughts. By identifying and challenging limiting beliefs around money, individuals can begin to reshape their financial outlook. Reflective journaling allows for deep self-exploration, helping to uncover and reframe negative narratives. As these insights come to light, replacing them with empowering beliefs becomes possible, paving the way for greater financial opportunities and healthier attitudes toward money. Engaging in visualization techniques and creating affirmations are powerful methods to nurture an abundance mindset. Visualizing success and repeating positive financial affirmations daily can reinforce confidence and motivation. Additionally, surrounding oneself with supportive and like-minded individuals provides encouragement and shared knowledge. Together, these practices foster a proactive approach to financial management, enabling individuals to achieve their financial goals and create a more secure, prosperous future. Chapter 2. Budgeting, the foundation of financial success. Budgeting serves as the foundation of financial success, providing a structured approach to managing personal finances. It offers a roadmap for allocating resources, making spending decisions, and tracking progress toward financial goals. Without a well-defined budget, it's easy to lose control over finances, leading to unnecessary debt and missed opportunities for saving and investing. This chapter will delve into the essential aspects of creating and maintaining a budget, paving the way to financial freedom and stability. In this chapter, readers will explore the significance of setting realistic financial goals using the SMART criteria: specific, measurable, achievable, relevant, and time-bound objectives. By understanding how to break down long-term goals into manageable steps, individuals can create a clear plan for their financial future. Additionally, the chapter will cover methods for tracking income and expenses, utilizing modern apps and tools to streamline the process. Readers will also learn how to categorize expenses and review them regularly to ensure alignment with their financial objectives. By the end of the chapter, readers will be equipped with practical strategies to achieve their financial aspirations and build a secure monetary foundation. Setting realistic financial goals. Setting achievable financial goals is a cornerstone for effective budgeting and, ultimately, financial success. Financial goals act as a roadmap, guiding how you allocate resources, make spending decisions, and measure your progress. One of the most effective methods for goal setting is using the SMART criteria, which stands for specific, measurable, achievable, relevant, and time-bound objectives. To start, setting specific goals means clearly defining what you want to achieve. Vague goals like save money or reduce debt do not offer clear direction. Instead, specify your objectives. For example, instead of saying save money, say save $5,000 for an emergency fund within the next year. This clarity helps in creating targeted strategies. Next, goals should be measurable. If a goal cannot be measured, it's hard to assess whether you are making progress. Quantifiable objectives, such as saving $100 per month or paying off $1,200 of credit card debt annually, allow you to track your advancements accurately. The achievable aspect ensures that your goals are realistic, given your current resources and constraints. For example, if you aim to pay off a $10,000 debt in 6 months, but have limited discretionary income, you may set yourself up for failure. Therefore, breaking this into smaller, more manageable payments might be a better approach. Relevance is key in linking your goals to your broader financial aspirations. Each objective should align with your long-term financial plans and personal priorities. For instance, if your primary concern is retirement, then focusing your goals towards building a substantial retirement fund would be relevant and beneficial. Finally, time-bound goals set deadlines for achieving them. A time frame creates a sense of urgency and helps maintain focus. Saying I will save $5,000 for an emergency fund by the end of next year is far more motivating than simply stating, I want to save money. Prioritizing financial goals is as crucial as setting them. Given limited resources, prioritization helps manage and allocate finances wisely. Start by listing all your financial goals, both short-term and long-term. Short-term goals might include creating a budget, saving for an emergency fund, or paying off a small debt. Long-term goals could encompass saving for retirement, buying a house, or funding your child's education. Once you have your list, determine the importance and urgency of each goal. Essentials like an emergency fund or high-interest debt repayment often take precedence because they provide immediate security and reduce financial strain. On the other hand, while saving for a vacation is beneficial, it likely comes after more urgent needs are met. Creating a timeline for achieving your financial goals is another step that brings structure and momentum to your efforts. Start with your highest priority goals and break them down into actionable steps. Suppose your goal is to save $20,000 for a down payment on a house within 5 years. Breaking this down, you'd need to save $4,000 annually, or approximately $333 monthly. Visualizing goals in smaller increments can make them seem less daunting and more attainable. Additionally, establishing milestones can help keep you motivated. For example, achieving quarterly savings targets can offer a sense of accomplishment and encourage continued effort towards your overall goal. Regularly revisiting and adjusting your financial goals is essential due to the dynamic nature of life circumstances and financial markets. Economic fluctuations, changes in income, or unexpected expenses can quickly alter your financial landscape. Therefore, it's crucial to review your goals periodically, ideally every quarter or at least annually. During these reviews, assess your progress toward each goal. Are you on track, ahead, or behind schedule? If you find that certain goals still seem unachievable, don't hesitate to adjust them. Flexibility is key to maintaining motivation and ensuring your goals remain within reach, even if external factors change. Moreover, revisiting your goals can open opportunities to refine your strategies. For example, if an investment performs well, you might redirect additional funds to expedite reaching other goals. Conversely, if expenses increase or income decreases, adjusting your monthly contributions can prevent significant setbacks. In summary, setting achievable financial goals is fundamental to effective budgeting and financial success. Utilizing the SMART criteria allows you to create clear, measurable, realistic, relevant, and time-bound objectives. Prioritizing these goals helps in managing resources efficiently, while structuring a detailed timeline provides a clear path to achieving them. Regularly reviewing and adjusting your goals ensures they remain aligned with your current situation and long-term aspirations. Tracking your income and expenses. Effective budgeting begins with a clear understanding of your income and expenses. This subpoint aims to present practical methods for tracking these financial elements, enabling better control over finances and greater awareness of spending habits. Utilizing apps and tools. In today's digital age, numerous apps and tools can simplify the process of tracking income and expenses. These applications are designed to help users plan ahead, rather than only reflect on past expenditures. One highly recommended app is YNAB, You Need a Budget, which follows a zero-based budgeting system. Users allocate every dollar they earn towards specific categories, such as spending, savings, and debt repayment. This hands-on approach can be immensely beneficial for those looking to become more intentional with their money. Every dollar is another excellent option for simple zero-based budgeting. It allows users to manually enter both income and outgoing money throughout the month, categorizing each transaction. The premium version even connects to bank accounts, offering custom reports and insights based on spending habits, which could prove invaluable for more detailed financial planning. For those who prefer a more automated approach, Empower Personal Dashboard offers robust features for tracking wealth and spending by connecting to various financial accounts, including checking, savings, credit cards, and even investment accounts. This app provides a comprehensive snapshot of recent transactions and categorizes expenses, helping users quickly understand where their money is going each month. Pocket Guard is another simplified budgeting tool that connects directly to your bank accounts, giving you a real-time view of your spending and how much money is available after accounting for bills and goals. This app is particularly useful for beginners who want an easy-to-understand display of their financial standing without needing to input data manually. Honeydew caters specifically to couples looking to manage shared expenses. It facilitates transparency by allowing partners to see each other's spending in select categories while maintaining some privacy. This can be extremely useful for households aiming to synchronize their financial efforts without micromanaging each other's expenditures. Creating a budget spreadsheet. While apps provide convenience, there's considerable merit in creating a personalized budget spreadsheet. Spreadsheets offer flexibility and customization options that can be tailored to individual needs. To set up a basic budget spreadsheet, start by listing all sources of income at the top, including salary, freelance earnings, and any other revenue streams. Next, create categories for expenses. Generally, expenses can be divided into fixed, variable, and discretionary costs. Fixed expenses include items like rent, mortgage payments, car loans, and insurance premiums, costs that remain the same each month. Variable expenses fluctuate and include groceries, utilities, and transportation. Discretionary expenses cover non-essential items, such as dining out, entertainment, and hobbies. By entering amounts under each category, individuals can easily compare their total income against their total expenses. This method not only provides a clear picture of current financial status, but also helps identify areas where adjustments can be made to improve savings and reduce unnecessary spending. Categorizing expenses. Categorizing expenses is a fundamental aspect of effective budgeting. By dividing costs into fixed, variable, and discretionary categories, individuals gain a deeper understanding of their spending patterns. This practice allows them to prioritize essential expenses and allocate funds more strategically. For instance, recognizing that a significant portion of one's income goes toward discretionary spending can prompt a reassessment of priorities, encouraging more prudent financial decisions. Fixed expenses typically include long-term commitments or regular payments that must be met, such as housing, utilities, and loan repayments. Because these do not change much from month to month, they form the backbone of your budgeting framework. On the other hand, variable expenses are those that can vary within each period. These might include costs for groceries, gasoline, or electricity bills. Monitoring and managing these can yield potential savings and highlight areas for cost cutting. Discretionary expenses are often the most flexible and should be scrutinized for possible reductions. Dining out, vacations, and leisure activities fall into this category. While cutting back on discretionary expenses can initially seem challenging, doing so can significantly boost overall savings and afford room for unexpected expenses or future investments. Regular expense reviews. A crucial part of maintaining an effective budget is conducting regular expense reviews. Periodic evaluations of expenditures against budget targets help ensure that spending stays aligned with financial goals. Schedule monthly or quarterly reviews to assess budget performance. During these reviews, note any variations between planned and actual spending. Such discrepancies can indicate areas where budget adjustments may be necessary. Regular reviews also provide an opportunity to reflect on financial habits and make informed decisions about future spending. For example, if utility bills consistently exceed expectations, it may be time to explore energy-saving measures or switch to a more cost-effective service provider. Additionally, these reviews can uncover patterns or trends that might not be immediately apparent, such as seasonal changes in spending or recurring unplanned expenses. By remaining vigilant and proactive in reviewing expenses, individuals can adjust their budgets to better suit their evolving financial situations. This adaptive approach not only minimizes the risk of overspending, but also maximizes the potential for reaching long-term financial goals. Moreover, consistently tracking performance fosters a disciplined mindset, encouraging better financial habits over time. Creating and sticking to a budget is instrumental for effective financial management. By setting realistic financial goals using the SMART criteria, you can clearly define what you want to achieve, track your progress, and ensure your objectives are attainable and relevant to your broader financial aspirations. Prioritizing these goals and structuring a timeline helps manage resources efficiently, making seemingly daunting tasks more manageable. Regular reviews of your progress allow for necessary adjustments, keeping your financial plans aligned with your current circumstances and long-term aims. In addition to goal setting, tracking income and expenses is crucial for maintaining control over personal finances. Utilizing apps and creating personalized budget spreadsheets offer practical ways to monitor spending habits, categorize expenses, and identify areas for potential savings. Regular expense reviews ensure that actual expenditures align with your financial goals, allowing for timely modifications. This comprehensive approach fosters disciplined financial habits, paving the way toward financial stability and success. Chapter 3. Investing for Beginners. Investing for beginners is about mastering the basics to build wealth over time. Grasping different types of investments is essential to selecting the right financial tools and making informed choices. The chapter delves into key investment options, demystifying complex terms and concepts to help you feel more confident and prepared as you embark on your investment journey. In this chapter, you'll learn about various investment vehicles such as stocks, bonds, mutual funds, ETFs, and real estate. You'll understand what each type entails, their potential risks and rewards, and how they fit into an overall investment strategy. By gaining insights into these fundamental components, you'll be well equipped to create a diversified portfolio tailored to your financial goals. This knowledge will empower you to take that first crucial step toward building a solid financial foundation and securing a prosperous future. Understanding different types of investments. Investing can be a daunting subject for beginners, but understanding the myriad of investment options available is key to choosing the right vehicles for your financial goals. This section aims to demystify stocks, bonds, mutual funds, ETFs, and real estate investments, providing you with the knowledge necessary to make informed decisions. Stocks represent shares of ownership in a company. When you purchase stock, you become a fractional owner of that company, entitled to a portion of its profits and assets. Stocks offer high returns, but come with higher risk due to market volatility. Historically, the stock market has shown significant growth, making it a potent tool for wealth accumulation. For example, the S&P 500 has returned an average annual rate of about 10% over the past several decades. However, it's essential to research market trends and company performance to mitigate risks and maximize returns. Understanding market dynamics is crucial for making informed stock decisions. Bonds are another common form of investment, representing loans made to entities like governments, municipalities, or corporations. When you buy a bond, you're essentially lending money to these entities, which they repay with interest over time. Bonds are generally safer than stocks because they offer fixed interest payments and return the principal at maturity. However, not all bonds are created equal. Their safety and returns depend on the issuer's credit rating. Knowledge of bond ratings can help assess the potential risks and rewards of investing in different types of bonds. For instance, U.S. Treasury bonds are considered very safe, but offer lower yields compared to corporate bonds, which carry higher risk but potentially higher returns. Mutual funds and ETFs, exchange-traded funds, are pooled investment vehicles designed to offer diversified portfolios. They allow investors to buy into a basket of different assets, thus spreading risk. Mutual funds are managed by professional fund managers who allocate the pooled funds into various securities. Unlike individual stocks or bonds, mutual funds do not trade on exchanges and are priced at the end of the trading day. ETFs, however, trade on stock exchanges and can be bought and sold throughout the trading day like regular stocks. They often track specific indices, such as the S&P 500, offering broad market exposure. One crucial factor to consider when investing in mutual funds or ETFs is the expense ratio, which represents the fees associated with managing the fund. Lower expense ratios generally mean higher net returns for investors. Real estate investment involves purchasing property to generate capital appreciation or rental income. This can be an effective way to build wealth and produce passive income. Real estate investments can range from residential properties like single-family homes to commercial real estate like office buildings and shopping centers. The value of real estate usually appreciates over time, and rental income can provide a steady stream of cash flow. However, real estate markets can be cyclical, and it's crucial to conduct thorough market research before investing. Factors like location, economic conditions, and property management can significantly impact the success of a real estate investment. For young professionals looking to establish a solid financial foundation, stocks offer a chance for substantial growth if approached with diligence and proper research. it's beneficial to start with well-known, stable companies and gradually diversify into smaller, high-growth opportunities as you gain confidence and experience. Midlife individuals concerned about retirement planning might find bonds appealing due to their stability and predictable interest payments. Bonds can add a layer of security to an investment portfolio, balancing out the volatility of stocks. Mutual funds and ETFs are excellent choices for both novices and seasoned investors due to their diversification benefits. These investment vehicles are particularly advantageous for those who lack the time or expertise to manage individual securities actively. By investing in mutual funds or ETFs, you leverage the expertise of professional fund managers while achieving a diversified portfolio. This approach can be especially comforting to anyone struggling with financial anxiety, as it simplifies the investment process and reduces the risk of significant losses from any single asset. When considering real estate, young professionals may want to explore entry-level investment opportunities, like buying properties in emerging neighborhoods or investing in real estate investment trusts, REITs. REITs operate like mutual funds, but focus on real estate properties, offering a way to invest in real estate without the headache of property management. Midlife individuals can look into owning rental properties as a means to generate passive income and secure their retirement. Conducting comprehensive market research, including evaluating local demand, property conditions, and potential for appreciation, will ensure more informed and lucrative investment decisions. The importance of diversification. Diversification is a cornerstone of successful investing, particularly for beginners looking to build wealth over time. Understanding why diversification is important and how to implement it effectively can be the difference between a robust investment portfolio and one that is overly vulnerable to market fluctuations. What is diversification? To grasp the importance of diversification, think of it as not putting all your eggs in one basket. In investment terms, this means spreading your investments across various asset classes, such as stocks, bonds, real estate, and perhaps even commodities or other alternative investments. The rationale behind this strategy is simple. If one particular investment performs poorly, the impact on your overall portfolio will be cushioned by better performing assets. For instance, if you invest solely in technology stocks, a downturn in the tech sector could severely harm your portfolio. But by also holding investments in bonds, real estate, or consumer goods industries, you mitigate this risk because these asset classes often do not correlate directly with each other. Strategies for diversification. One effective strategy for achieving diversification is to mix different types of investments. Stocks provide growth potential, but come with higher volatility. Bonds, on the other hand, are generally more stable, but offer lower returns. Real estate can provide both capital appreciation and income through rent, serving as a good balance between risk and reward. By combining these different asset classes, you create a more stable portfolio that can weather different market conditions. Another useful technique is dollar cost averaging. This involves investing a fixed amount of money at regular intervals, regardless of market conditions. By doing so, you buy more shares when prices are low and fewer shares when prices are high, reducing the average cost per share over time. This method helps manage the risks associated with market volatility and emotional investing, making it easier to stay committed to your long-term investment plan. Risk management through diversification. The protective role of diversification becomes especially apparent during sudden market shifts. For example, an unforeseen economic event might drastically affect a single industry, causing significant losses for investors who are heavily concentrated in that sector. Diversification helps protect against such scenarios by distributing exposure across various sectors and industries. Familiarity with different areas of the market can broaden your investment horizons and reduce reliance on any single source of returns. Consider the 2008 financial crisis that devastated many stock portfolios. Investors who had diversified into bonds, gold, or even international markets were better equipped to handle the downturn. Similarly, during the COVID-19 pandemic, certain sectors like travel and hospitality suffered immensely, while technology and healthcare thrived. A well-diversified portfolio would have balanced these impacts, offering more stability and less dramatic losses. Common misconceptions. While diversification is a powerful tool, it's crucial to understand that it is not a surefire way to guarantee success. One common misconception is that simply diversifying one's portfolio will automatically lead to high returns. This notion can lead to complacency, where investors may neglect the need for continual research and active management. Another pitfall is over-diversification, which can dilute potential returns. By spreading investments too thinly, an investor may end up with a portfolio that mimics an index fund without the benefit of targeted high-return opportunities. The goal is to strike a balance. Diversify enough to manage risk, but not so much that potential gains from high-performing investments are watered down. Investors must also be aware of the costs associated with maintaining a diversified portfolio. Transaction fees, management fees for mutual funds or ETFs, and potential tax implications can add up over time. It's essential to factor in these costs when planning your diversification strategy to ensure they don't erode your returns. Practical guidelines for diversification. To effectively diversify your investment portfolio, start by assessing your risk tolerance and financial goals. Younger investors with a longer time horizon might opt for a higher allocation in stocks for growth potential, while those nearing retirement may prefer bonds and income-generating assets for stability. Rebalancing your portfolio periodically is another critical step. As different assets grow at varying rates, your portfolio's initial allocation can shift over time. Regular rebalancing ensures that you maintain your desired level of risk and return. For instance, if stocks perform exceptionally well and begin to constitute a larger portion of your portfolio than intended, selling some of the stocks and buying bonds or other underrepresented assets can bring your portfolio back in line with your target allocation. Additionally, consider geographical diversification by investing in international markets. Different regions can provide unique growth opportunities and reduce exposure to country-specific risks. Investing in foreign stocks, bonds, or index funds allows you to benefit from global economic developments and further insulate your portfolio from localized downturns. Lastly, educate yourself continuously about the various investment options available. Whether it's through books, online courses, or financial advisors, staying informed will help you make better decisions and adapt to changing market conditions. Mastering the basics of investing is crucial for anyone aiming to build wealth over time. This chapter has delved into various investment options, explaining how each can serve different financial goals. From the potential high returns of stocks and the stability of bonds to the diversification benefits of mutual funds and ETFs, we have explored how each investment type can fit into your overall strategy. Additionally, the chapter has highlighted real estate as a viable option for generating income and appreciation, providing practical insights into assessing these opportunities. This knowledge serves as a foundation for making informed decisions that align with your financial objectives, whether you're a young professional starting your journey or someone in midlife focusing on securing retirement. By understanding the characteristics, risks, and benefits of each investment option, you are better equipped to diversify effectively and mitigate risks. Armed with this information, you can confidently take the next steps toward achieving your financial goals and building a secure, prosperous future. Chapter 4. Generating Passive Income. Generating passive income is about creating multiple streams of revenue that require little to no effort to maintain, allowing individuals to achieve financial independence and security. This approach focuses on building a diversified portfolio of income sources that can provide consistent returns over time without the necessity of active involvement. For many, this means exploring opportunities like real estate investments, dividend-paying stocks, peer-to-peer lending, and creating digital products such as online courses or ebooks. Each of these avenues offers unique benefits and challenges, catering to different skills, interests, and risk tolerances, making it possible for anyone to find a suitable path toward generating passive income. In this chapter, the discussion will center around various passive income opportunities and how they can be effectively utilized to build a more secure financial future. The exploration will include detailed insights into investing in real estate, understanding dividend-paying stocks, engaging in peer-to-peer lending, and leveraging one's expertise to create online courses or ebooks. The chapter will outline the steps involved in each method, highlight potential risks and rewards, and offer practical advice for those looking to diversify their income streams. By understanding these options and implementing the strategies discussed, readers will be better equipped to generate passive income and move closer to achieving financial independence. Exploring various passive income opportunities. Generating multiple streams of passive income is a crucial strategy for achieving financial independence and securing a stable future. There are various avenues available, each catering to different skills and interests. Among these, investing in real estate, dividend-paying stocks, peer-to-peer lending, and creating online courses or ebooks stand out as effective methods. Investing in real estate has long been regarded as a reliable way to generate passive income. By purchasing properties, investors can earn rental income while also benefiting from property appreciation over time. Rental income provides steady monthly revenue that can cover mortgage payments and other expenses, eventually turning into a profit once the property is paid off. For example, owning an apartment building in a sought-after location can yield substantial rental income month after month. Moreover, real estate typically appreciates in value over the years, adding another layer of potential financial gain. To succeed in real estate investment, it's essential to consider various factors such as the property's location, condition, and market trends. Conducting thorough research and seeking professional advice can help identify properties with high rental demand and good appreciation potential. Real estate offers diversification in an investment portfolio, providing a hedge against inflation, since property values and rents tend to rise with inflation rates. One should be prepared for high upfront costs, including down payments, closing fees, and possible renovation expenses. Despite these initial hurdles, the long-term benefits often outweigh the disadvantages, making real estate a compelling option for passive income generation. Dividend-paying stocks are another avenue for generating passive income. These stocks represent shares in companies that distribute a portion of their earnings to shareholders on a regular basis, typically quarterly. This provides investors with a consistent income stream that can be reinvested to compound growth or used to supplement other income sources. Companies with a strong track record of paying dividends tend to be more stable and less volatile than those focused solely on growth. When selecting dividend stocks, it's important to look for companies with a history of increasing their payouts, as this indicates financial health and a commitment to returning capital to shareholders. Investing in a diversified portfolio of dividend-paying stocks can reduce risk and provide a balanced approach to income generation. Reinvesting dividends through dividend reinvestment plans, DRIPs, allows investors to purchase additional shares automatically, compounding their returns over time. This strategy can significantly boost long-term wealth without requiring ongoing effort from the investor. Peer-to-peer lending presents an innovative alternative to traditional banking, allowing individuals to lend money directly to borrowers through online platforms. By participating in peer-to-peer lending, investors can earn interest income by assessing borrower risk and diversifying their loan investments. Platforms like Prosper and Lending Club connect lenders with vetted borrowers, offering the potential for higher returns compared to traditional savings accounts or bonds. While peer-to-peer lending involves some risk, due diligence and diversification can mitigate potential losses. Lenders should analyze borrowers' creditworthiness, loan purpose, and repayment history before committing funds. Diversifying across multiple loans and borrowers can spread risk and enhance the likelihood of consistent returns. Peer-to-peer lending appeals to those comfortable with evaluating credit risk and seeking higher yields on their investments. However, It's crucial not to invest more money than one can afford to lose, as defaults can impact overall returns. Creating online courses or ebooks leverages one's expertise and knowledge into products that generate passive income with minimal ongoing effort after initial creation. With the growing demand for online education, platforms like Udemy and Teachable provide opportunities for educators and experts to share their skills and earn money. Developing a comprehensive course or writing an informative ebook requires an upfront investment of time and effort, but can yield significant returns once published. Successful online courses often cover in-demand topics and offer engaging content through videos, text, quizzes, and interactive elements. It's essential to choose a subject you are passionate about and that has market demand. Designing the course around your schedule allows flexibility and updates as needed to keep content relevant. Providing additional support, such as Quanda sessions or community forums, can enhance student engagement and satisfaction, leading to positive reviews and recommendations. Ebooks offer another avenue for passive income, especially for those who enjoy writing. Once written and published, ebooks can generate sales without further input from the author. Choosing a niche topic or addressing common problems can attract a dedicated audience. Marketing efforts, such as leveraging social media and email newsletters, can boost visibility and drive sales. Building and automating income generation. Generating additional income through a side hustle can be both exciting and challenging. It's not just about earning more money. It's about finding a balance, managing your time effectively, and leveraging automation to create sustainable passive income streams. The journey begins with identifying personal skills and understanding market demand to select a side hustle that aligns with your passions and interests. First, identifying your unique skills and assessing the market demand is vital. It helps if you start by listing your interests, hobbies, and professional skills. This reflective exercise enables you to pinpoint areas where you excel and feel passionate. For instance, someone with graphic design skills could consider freelancing on platforms like Fiverr or Upwork. Additionally, analyzing market trends using tools like Google Keyword Planner can provide insights into what people are searching for, indicating potential high-demand areas. By aligning your side hustle with both your skills and market needs, you increase the likelihood of profitability and personal satisfaction. Once you have identified a suitable side hustle, effective planning and time management become crucial in balancing it with a full-time job or other commitments. Begin by conducting a comprehensive audit of how you currently spend your time. Identify non-essential activities that can be eliminated or reduced to free up time for your side hustle. Utilizing time-tracking apps or methods like the Pomodoro technique can help optimize productivity. Creating a structured schedule is essential. Dedicate specific time slots for your side hustle and treat them as seriously as any other appointment. Prioritize tasks based on their urgency and importance, ensuring critical activities receive attention first. Avoid multitasking, as it often reduces productivity and increases stress. Instead, focus on completing one task at a time to ensure higher quality work. Incorporating technology tools and platforms is a game changer in automating income generation. Automation minimizes manual effort, allowing you to focus on strategic growth areas. For example, affiliate marketing programs can automate revenue streams by connecting consumers with products and capturing commissions without constant intervention. Similarly, creating an e-commerce store with automated order processing and inventory management can significantly reduce the workload. AI-powered tools like Nvidio.ai can streamline content creation processes, transforming text into engaging videos with minimal effort. Additionally, scheduling tools like Buffer or Hootsuite can automate social media postings, keeping your audience engaged while freeing up your time. Outsourcing is another powerful strategy to streamline operations and focus on high-impact areas. By delegating routine or specialized tasks to virtual assistants or freelancers, You can enhance efficiency and scale your side hustle faster. Tasks such as customer service, bookkeeping, and content creation can often be outsourced cost-effectively. When outsourcing, it's important to clearly define roles and set expectations to ensure consistent quality and reliability. Hiring virtual assistants from reputable platforms ensures that you get qualified help tailored to your needs. Outsourcing recurrent tasks also allows you to concentrate on scaling your business and exploring new growth opportunities. Taking inspiration from successful entrepreneurs can provide practical examples of how to integrate these strategies. Consider the story of Sarah, a blogger who turned her passion for cooking into a thriving business. She started her blog to share recipes and cooking tips, but it quickly gained traction. Recognizing the potential, she automated many aspects of her blog using AI tools for content optimization and social media scheduling. By incorporating affiliate marketing and sponsored content, Sarah created multiple revenue streams. She also outsourced website management and focused on creating high-quality content. This approach not only increased her income, but also allowed her to dedicate more time to growing her brand. Similarly, David, a landscape photographer, leveraged automation to monetize his art beyond traditional gallery sales. He set up an online store offering automated digital downloads of his photographs, enabling customers to purchase his work anytime without requiring his direct involvement. David used AI to analyze market trends and customer preferences, which helped him adjust his portfolio to include highly sought-after scenes. This strategy not only boosted his sales, but also expanded his reach globally. Automated social media tools ensured his photographs remained visible to a broad audience, further enhancing his passive income stream. Effective financial management is also critical in sustaining and growing a side hustle. Developing financial literacy involves understanding how to track expenses and revenue accurately. Use finance management tools like QuickBooks or FreshBooks to keep meticulous records. This practice helps you identify profitable areas and reinvest wisely. Setting aside a portion of your income for taxes, emergencies, and future investments is also prudent. Regularly reviewing your financial statements allows you to make informed decisions and adjust your strategies as needed. Remember, the success of a side hustle hinges on continuous learning and improvement. Stay updated with industry trends and innovations. Participate in webinars, workshops, and networking events to expand your knowledge and connections. Joining entrepreneurial communities, either online or locally, can provide support, inspiration, and valuable insights from peers. Collaborating with like-minded individuals opens doors to potential partnerships and synergies that can propel your side hustle to new heights. As this chapter illustrates, creating multiple streams of passive income is essential for achieving financial independence. By exploring options such as real estate investments, dividend-paying stocks, peer-to-peer lending, and developing online courses or ebooks, individuals can tailor their income strategies to their unique skills and interests. Real estate offers steady rental income and property appreciation, while dividend-paying stocks provide consistent payouts that can compound over time. Peer-to-peer lending presents higher interest returns with some manageable risks, and online courses or ebooks allow leveraging expertise into ongoing earnings. To effectively implement these strategies, it's important to conduct thorough research and consider factors like market trends and personal risk tolerance. Investing time in planning and diversifying your income sources mitigates risks and enhances long-term stability. Whether you are a young professional building a financial foundation, someone mid-career planning for retirement, or an individual seeking to overcome financial challenges, these passive income avenues offer valuable opportunities. Balancing effort between these methods ensures that you create a resilient financial portfolio capable of supporting your future goals. Chapter 5. Managing and Reducing Debt. Managing and reducing debt is a matter of understanding effective strategies that not only handle your existing obligations, but also aid in growing your wealth. The concept begins with recognizing the different types of debt and their impacts on financial health. By delving into these various forms, you gain the knowledge necessary to make informed decisions that align with your financial goals. Whether it's differentiating between secured and unsecured debts, or understanding good versus bad debt, each type plays a unique role in shaping your financial stability. This chapter will guide you through creating a successful debt repayment plan while emphasizing ways to manage your debt effectively at various life stages. You'll learn about methods like the avalanche and snowball approaches for tackling debt, setting achievable milestones, and making additional payments to expedite your debt settlement. Additionally, we'll explore budgeting strategies, such as the 50-30-20 rule, and discuss how to establish an emergency fund to avoid future indebtedness. With these tools and strategies, you'll be equipped to regain control over your finances and work towards a secure financial future. Understanding different types of debt and their impact. Understanding and managing debt is crucial for building a stable financial future. Not all debt is created equal, and different types of debt can have varied impacts on your financial health. By learning about these differences, you can make informed decisions that align with your financial goals. Secured versus unsecured debt is a fundamental distinction to grasp. Secured debt is backed by collateral, assets like a house or car that the lender can claim if you default. Mortgages and auto loans are common examples. Because these loans are less risky for lenders, they often come with lower interest rates and more favorable terms. However, the stakes are high. Failure to repay could mean losing your home or vehicle. On the other hand, unsecured debt includes credit card debt, personal loans, and medical bills, which aren't tied to any specific asset. These loans typically carry higher interest rates due to the increased risk for lenders and require stronger credit histories for approval. The lack of collateral might seem advantageous, but it also means that late payments can severely harm your credit score and lead to exorbitant fees. Another vital concept is distinguishing between good debt and bad debt. Good debt is viewed as an investment that will grow in value or generate long-term income. Examples include student loans and mortgages. Taking on student loans can be beneficial if it leads to higher income through better education. Similarly, a mortgage can be considered good debt if it allows you to build equity in a property that appreciates over time. Conversely, bad debt refers to borrowing that doesn't improve your financial position and often comes with high interest rates. Credit card debt used for non-essential items is a prime example of bad debt. Such borrowing habits can create a cycle of debt that becomes difficult to escape, hindering your financial growth. The effect of various debts on your credit score and borrowing costs cannot be overstated. Your credit score is a critical indicator of your financial health and influences your ability to secure future loans, rent housing, and sometimes even get a job. Different types of debt affect your credit score in varied ways. For instance, revolving debts like credit cards can impact your credit utilization ratio, the percentage of available credit you're using. High utilization can reduce your credit score significantly. Installment loans, such as mortgages or auto loans, which involve regular payments over a fixed period, tend to have a less volatile effect on your score as long as payments are made promptly. Late payments on any type of debt can result in penalties and a drop in your credit score, making future borrowing more expensive and challenging. Debt management approaches should be tailored to different life stages for maximum effectiveness. Young professionals need to focus on establishing a solid credit history while avoiding excessive debt. Prioritizing paying off high-interest debt and investing in assets like further education can set the stage for future financial success. As individuals progress into midlife, their focus may shift towards securing a stable financial future and preparing for retirement. At this stage, managing mortgage payments efficiently while avoiding new, unnecessary debt is crucial. Understanding that some debts can offer tax benefits, like the mortgage interest deduction, can also be beneficial. For those nearing retirement or already retired, the emphasis should be on minimizing debt to preserve retirement savings. Paying down existing debts before retirement can reduce monthly expenses and ease financial stress. Recognizing the nuances between different types of debt and their implications can help retirees avoid financial pitfalls and maintain a comfortable lifestyle. Creating and implementing a debt repayment plan. Creating an effective debt repayment plan is crucial for managing and reducing debt while achieving your financial goals. The first step involves a thorough assessment of your current debt situation, including the total amount owed, interest rates, and terms of each debt. This will provide clarity on where to focus your efforts. When assessing your debts, gather all relevant information: balances, interest rates, monthly payments, and due dates. This comprehensive overview will help you understand the magnitude of your debt and prioritize which debts to tackle first. For example, high-interest debts should usually be prioritized as they accrue more cost over time. Once you have a clear picture of your debt, consider different repayment methods, such as the avalanche and snowball approaches. The avalanche method involves paying off debts with the highest interest rates first. This strategy minimizes the overall cost of debt, since high-interest debts are more expensive in the long run. By tackling these first, you reduce the amount of interest paid over time, ultimately saving money. In contrast, the snowball method focuses on paying off the smallest debts first, regardless of interest rates. This approach leverages the psychological benefits of quick wins. Eliminating smaller debts can provide a sense of accomplishment and motivate you to continue with your debt repayment plan. Although it might not save as much on interest, the emotional boost can be significant. Choose the method that aligns best with your financial goals and psychological needs. Setting achievable milestones within your repayment strategy is essential to maintain progress and motivation. Break down your overall repayment goal into smaller, manageable targets. For instance, aim to pay off a specific credit card balance within 6 months, or reduce your overall debt by a certain percentage within a year. Celebrating these milestones can foster a positive mindset and keep you committed to your repayment plan. Making additional payments whenever possible can significantly accelerate debt reduction. Consider using bonuses, tax refunds, or any extra income to make lump sum payments towards your debts. Additional payments can reduce the principal balance quicker, lowering the amount of interest accrued and speeding up the repayment process. For instance, if you receive a bonus at work, earmark a portion of it exclusively for debt repayment instead of spending it on discretionary items. Another strategy to incorporate is finding ways to free up extra money within your monthly budget. Review your expenses and identify areas where you can cut back. Maybe dine out less frequently or limit your subscriptions. Redirecting these savings towards your debt repayment can make a noticeable difference over time. Additionally, consider taking on a temporary side job or freelance work. Any extra earnings can go directly toward reducing your debt. Establishing an emergency fund, even while repaying debt, is essential to avoid taking on new debt in case of unexpected expenses. Aim to save a small buffer amount, say $500 to $1,000 initially, to cover minor emergencies. This way, you won't need to rely on credit cards or loans when unforeseen costs arise. Building this fund might slow down your debt repayment slightly, but it provides financial security and prevents further debt accumulation. Creating and adhering to a budget is foundational for a successful debt repayment plan. Start by tracking all sources of income and categorizing expenses into mandatory and discretionary. Mandatory expenses include bills, groceries, and debt payments, while discretionary expenses encompass dining out, entertainment, and hobbies. Using a budgeting strategy, like the 50-30-20 rule, allocate 50% of your income to necessities, including minimum debt payments, 30% to discretionary spending, and 20% to savings and additional debt payments. This structured approach ensures that your debt repayment is consistently prioritized while maintaining a balanced lifestyle. Regularly reviewing your financial goals and adjusting your strategies is necessary to stay on track. Life circumstances change, and so might your income, expenses, and debt obligations. Schedule periodic reviews, perhaps quarterly, to assess your progress and make necessary adjustments. For example, if you receive a raise or promotion, increase your debt payment amounts accordingly. In conclusion, understanding the different types of debt and their impacts on your financial health is essential for managing and reducing debt while also growing your wealth. By distinguishing between secured and unsecured debts, as well as good and bad debts, you can make informed decisions that align with your financial goals. Recognizing how various debts affect your credit score further aids in making strategic choices to maintain or improve your financial standing. Implementing a tailored debt repayment plan is crucial for achieving these objectives. Whether you choose the avalanche or snowball method, setting achievable milestones and making additional payments can accelerate debt reduction. Additionally, establishing an emergency fund and adhering to a structured budget helps avoid new debt and ensures steady progress towards financial stability. Regularly reviewing and adjusting your strategies will help keep you on track and adapt to any changes in your financial situation, ultimately leading to a more secure and prosperous future. Chapter 6: Smart Spending Habits. Developing smart spending habits is essential for achieving greater savings and making wise financial decisions. By distinguishing between needs and wants, individuals can lay a solid foundation for their financial well-being. Recognizing what is necessary for daily living versus what merely enhances comfort helps prioritize expenditures and allocate resources more effectively. For example, paying rent or mortgage is vital, as it ensures stable housing, while dining at fancy restaurants may offer pleasure, but isn't essential. Implementing strategies like the 30-day rule can also curb impulsive buying by encouraging reflection before making non-essential purchases. Creating a spending hierarchy further organizes financial commitments by categorizing expenses into fixed and variable elements, ensuring that crucial needs are always met first. This chapter delves into practical methods to refine your spending habits. It highlights the importance of using tools and apps like Mint and YNAB for better financial tracking and planning. Traditional budgeting techniques, such as the envelope system, are also discussed, offering diverse approaches to managing money. Additionally, the chapter emphasizes reviewing monthly statements to identify unnecessary recurring charges and avoid lifestyle inflation. Simple practices like adopting DIY solutions and focusing on value over price when making purchases can significantly reduce costs. By following these guidelines, readers will be equipped with actionable steps to enhance their financial literacy and achieve long-term savings and stability. Distinguishing between needs and wants. Identifying essential expenditures versus discretionary spending is a crucial step in developing smart financial habits. Understanding the difference between needs and wants can provide a solid foundation for making wise financial decisions. First, let's delve into understanding needs versus wants. Needs are essentials required for survival and daily functioning. These include basic necessities like food, shelter, clothing, healthcare, and transportation. Ensuring these needs are met is crucial for maintaining a stable and healthy lifestyle. For example, paying rent or mortgage is a need because having a place to live is fundamental. On the other hand, wants are non-essential items that enhance quality of life, but are not necessary for day-to-day survival. These can be things like dining at fancy restaurants, buying the latest smartphone, or going on vacation. Wants bring joy and comfort, but can often be postponed or even eliminated without significant impact on one's well-being. Distinguishing between needs and wants helps prioritize spending and allocate resources more effectively. One practical strategy to manage discretionary spending is the 30-day rule. This rule involves waiting 30 days before making a non-essential purchase. During this waiting period, you have time to reflect on whether the item is truly necessary or just an impulsive desire. If after 30 days you still feel strongly about the purchase, it may be a sign that it's a worthwhile investment. However, more often than not, the initial urge to buy fades, helping you save money that would have otherwise been spent impulsively. For instance, imagine spotting a new gadget online that you think you can't live without. Instead of buying it immediately, add it to your cart and wait for 30 days. After a month, go back and reevaluate if the gadget still holds the same appeal, or if it's something you can do without. Many people find that they lose interest over time, which highlights how effective the 30-day rule can be in curbing unnecessary expenditures. Creating a spending hierarchy can further streamline your financial decisions. This involves categorizing purchases by priority to ensure that essential expenses are always covered first. Start by listing your fixed expenses such as groceries, housing, utilities, and debt repayments. These are non-negotiable payments that must be made each month. Next, consider variable expenses which fluctuate monthly, like entertainment, dining out, and hobbies. While these can enhance your lifestyle, they should not take precedence over your essential costs. A clear spending hierarchy also provides a framework to make tough financial choices. For example, if there's a month where your budget is tight, knowing which expenditures are flexible, like skipping a movie night, versus fixed, like paying your electricity bill, can help manage funds more efficiently. This approach reduces financial stress by ensuring that critical needs are always met, and any surplus can be allocated towards savings or occasional indulgences. In addition to these strategies, utilizing practical tools for evaluation can significantly enhance your ability to track and review spending. Numerous apps and methods are designed to assist with budgeting and financial planning. Apps like Mint, YNAB, You Need a Budget, and Pocket Guard offer user-friendly interfaces that categorize expenses, set budget limits, and provide detailed spending reports. These tools not only track your transactions, but also send alerts if you're approaching your budget limit, enabling better control over your finances. Moreover, employing traditional methods like the envelope system can be equally effective. This method involves allocating a set amount of cash for various expenditure categories, for example, groceries, entertainment, at the beginning of each month. Once the cash in a particular envelope is depleted, no more spending is allowed in that category until the next month. This tangible approach can help reinforce disciplined spending habits. Regularly reviewing your financial activity using these tools ensures transparency and accountability in your spending patterns. By analyzing where your money goes each month, you can identify areas for improvement and make informed adjustments to your budget. For example, if you notice a significant portion of your income is spent on dining out, you might decide to cook more meals at home to save money. Essentially, establishing a routine of tracking expenditures will ingrain prudent financial habits, leading to long-term savings and better financial health. Leveraging modern technology and time-tested methods will provide a comprehensive overview of your financial situation, empowering you to make educated decisions. Finding ways to cut unnecessary expenses and maximizing purchase value. Identifying and eliminating unnecessary costs is crucial for establishing smart spending habits. It starts with a fundamental strategy: analyzing monthly statements. Young professionals, midlife individuals, and anyone experiencing financial anxiety can benefit from scrutinizing their monthly bank and credit card statements. By taking a close look at these statements, you can identify recurring charges that may no longer be necessary, or even spot errors that need correction. For example, subscription services can often slip through the cracks. You might have signed up for a streaming service during a free trial and forgot to cancel it. By regularly reviewing your statements, you can catch these expenses and make the decision to either continue or discontinue them based on their utility in your life. One effective guideline is to set aside a specific time each month to go through your financial statements meticulously, highlight any charges that seem unfamiliar or unnecessary, and investigate further to determine whether they should be canceled or contested. In addition to scrutinizing statements, avoiding lifestyle inflation is another critical tactic for managing finances smartly. Lifestyle inflation occurs when an increase in income leads to higher spending rather than saving. For instance, receiving a raise at work might tempt you to upgrade your lifestyle with a more expensive car or frequent dining out. While it's natural to want to enjoy the fruits of your labor, it's important to distinguish between genuine needs and desires driven by increased income. To avoid this pitfall, establish a clear budget that aligns with your financial goals. Set limits on discretionary spending and stick to them, regardless of income increases. A practical illustration of this could be allocating a fixed percentage of any salary increase directly into savings or investments. This not only helps in resisting lifestyle inflation, but also aids in building long-term wealth. Adopting the DIY approach can also significantly reduce costs. Many tasks we often outsource can be done at home with minimal resources. For example, instead of hiring a professional for minor home repairs, consider learning how to fix these issues yourself. The same goes for cooking at home instead of eating out frequently. Cooking not only saves money, but often results in healthier meals. There are numerous resources available online, such as video tutorials, blogs, and forums, where you can learn various DIY skills. These skills aren't limited to home repairs. They can range from gardening to making homemade gifts, all of which contribute to reducing unnecessary expenditures. Establishing a mindset geared towards self-reliance can greatly enhance your ability to save money and foster a sense of accomplishment. Moreover, focusing on value over price is essential when making purchasing decisions. While it might be tempting to opt for cheaper options, these aren't always the most cost-effective in the long run. Cheaper products often lack durability and end up costing more due to frequent replacements. Investing in quality items ensures longevity and better performance, ultimately offering greater value. For example, purchasing a high-quality pair of shoes might seem pricey initially, but if they last for years compared to cheaper ones that wear out quickly, the overall cost becomes lower over time. Similarly, buying energy-efficient appliances might require a larger upfront investment, but the savings on utility bills offset this initial cost. When considering a purchase, conduct thorough research and read reviews to gauge the product's quality and durability. This practice will help ensure that you spend your money wisely and get the best value for each dollar spent. In this chapter, we've emphasized the importance of distinguishing between needs and wants to cultivate smart spending habits. By understanding what is essential and what can be considered a luxury, you can better prioritize your expenses and ensure that your most critical needs are met first. Practical strategies like the 30-day rule and establishing a spending hierarchy help manage discretionary spending effectively. Furthermore, utilizing modern tools as well as traditional methods for tracking and reviewing expenditures ensures that you maintain a clear perspective on where your money goes each month. Additionally, we explored ways to cut unnecessary expenses and maximize the value of your purchases. Analyzing monthly statements allows you to identify and eliminate unneeded costs, while avoiding lifestyle inflation ensures that increased income goes towards savings rather than elevated spending. Adopting DIY approaches and focusing on quality over price also contribute to more prudent financial management. These combined efforts ultimately lead to long-term savings and a more secure financial future, helping you make informed decisions and achieve greater financial stability. Chapter 7. Financial Literacy and Education. Financial literacy is essential for anyone aiming to achieve financial stability and growth. Understanding personal finance involves knowing how to manage income, expenses, and net worth effectively. Knowledge in these areas provides a clear view of one's financial standing and facilitates the creation of strategies for improving it. Informed financial decisions are made possible by comprehending where money comes from and where it goes, which is crucial for setting and achieving financial goals. This chapter will delve into key principles of financial literacy, including income management, expense tracking, and understanding net worth. It will explain the time value of money and its implications on investment choices and saving strategies. Practical advice on budgeting, such as utilizing the 50-30-20 rule and zero-based budgeting, will be covered to help maintain financial stability. Additionally, the chapter will emphasize the importance of setting realistic financial goals that align with personal values and adjusting them as circumstances change. Key principles of financial literacy. Understanding personal finance is the first step towards making informed financial decisions. Personal finance is a broad term that covers all aspects of managing your money, including income, expenses, and net worth. By comprehending these components, you can gain a clear picture of where you stand financially. Knowing where your money comes from and where it goes helps in creating strategies for financial stability and growth. Income is the cornerstone of personal finance. It includes your salary, bonuses, freelance earnings, and any passive income streams like dividends or rental income. Tracking your income is crucial because it sets the foundation for budgeting and savings. It's not just about how much you earn, but also about understanding the sources of your income and their reliability. For instance, a steady job offers predictable income, while freelance work might be irregular but potentially lucrative. Expenses, on the other hand, are the outflows of your money. These include necessities like rent, utilities, groceries, and discretionary spending, like dining out or traveling. Keeping a detailed record of your expenditures allows you to see patterns and identify areas for potential savings. Analyzing your expenses can highlight unnecessary costs and help you redirect funds towards more important financial goals. Tools like expense tracking apps or simple spreadsheets can make this process manageable and insightful. Net worth is another vital component of personal finance. It's calculated by subtracting your liabilities, debts, from your assets, what you own. Understanding your net worth gives you a snapshot of your financial health. Regularly updating this figure helps you track progress over time, indicating whether you are moving closer to financial independence. Increasing net worth means either increasing assets, reducing liabilities, or both. Next, let's discuss the time value of money, a fundamental concept in finance. This principle states that $1 today is worth more than $1 in the future due to its earning potential. Understanding this can lead to better investment choices and saving strategies. Early investing is advantageous because it leverages the power of compound interest. Compound interest allows your investments to grow exponentially as you earn returns on both the initial capital and the accumulated interest over time. For example, if you start investing $200 per month at age 25 with an annual return of 7%, you could accumulate significantly more wealth by retirement compared to starting at age 35 with the same monthly contribution and return rate. The earlier you start, the more time your money has to grow. This highlights why young professionals should prioritize beginning their investment journey early to maximize their financial potential. Saving strategies also benefit from the time value of money. Setting aside money regularly, even in small amounts, can lead to substantial growth over time. Emergency funds, retirement accounts, and other long-term savings vehicles should be initiated as soon as possible to take full advantage of compounding. Consistency in saving is key. Automated transfers to savings or investment accounts can ease this process and ensure regular contributions. Budgeting basics are another crucial aspect of financial literacy. A well-structured budget tracks spending, sets savings goals, and prevents overspending and debt accumulation. Start by categorizing your monthly expenses into fixed, rent, utilities, payments, and variable, groceries, entertainment. Allocate income towards these categories while ensuring you have room for savings and unexpected expenses. One effective budgeting method is the 50-30-20 rule. 50% of your income goes to needs, 30% to wants, and 20% to savings or debt repayment. This structure provides a balanced approach, ensuring essentials are covered while also prioritizing financial growth. Regularly reviewing and adjusting the budget based on changes in income or expenses helps maintain its effectiveness. Another practical tool is zero-based budgeting, where every dollar is assigned a purpose until the balance equals zero. This doesn't mean spending everything. Instead, it means ensuring each dollar is allocated either to expenses, savings, or investments. Zero-based budgeting promotes mindful spending and maximizes resource utilization. Finally, establishing realistic financial goals aligned with personal values is essential for ongoing financial success. Goals provide direction and motivation, making financial planning purposeful. Begin by identifying short-term, medium-term, and long-term goals. Short-term goals might include building an emergency fund or paying off credit card debt, while medium-term goals could involve saving for a down payment on a house. Long-term goals often focus on retirement planning. Align your financial goals with personal values to ensure they resonate with what matters most to you. For example, if family security is a priority, focus on building a robust emergency fund and investing in education or insurance plans. If you value experiences, allocate funds towards travel or hobbies, but within a structured financial plan that doesn't compromise overall stability. Adjusting goals as circumstances change ensures they remain relevant and achievable. Life events such as marriage, having children, career changes, or unexpected financial windfalls or emergencies will require revisiting and possibly revising your goals. Flexibility is key to adapting to life's dynamic nature while staying committed to long-term objectives. Resources for ongoing financial education. In today's rapidly changing financial landscape, acquiring the right tools and resources for continuous learning is essential to make informed decisions. Here we delve into various methods to enhance your financial knowledge. Leveraging books and audiobooks, enrolling in online courses, engaging with podcasts and YouTube channels, and participating in financial blogs and forums. Firstly, books and audiobooks offer a wealth of knowledge on complex financial topics. They are an invaluable resource for those who prefer traditional learning formats or need flexibility due to busy schedules. For young professionals looking to build a solid financial foundation, titles such as Rich Dad, Poor Dad by Robert Kiyosaki or The Millionaire Next Door by Thomas J. Stanley provide timeless advice on budgeting, investing, and wealth creation. Individuals in midlife can benefit from works like Your Money or Your Life by Vicki Robin, which offers insights into aligning financial goals with personal values and retirement planning. Audiobooks serve as an excellent alternative for those who are constantly on the move, allowing learning during commutes or workouts. Recommended readings can further deepen understanding, making it easier to grasp intricate concepts and apply them practically. Moving on to online courses and webinars, these platforms offer structured learning experiences and certifications across varying levels of expertise. Courses on websites like Coursera, Udemy, and Khan Academy cover a broad spectrum of topics, from basic personal finance management to advanced investment strategies. Webinars hosted by financial experts provide real-time learning opportunities, often accompanied by Quanda sessions, where participants can clarify doubts and gain personalized advice. For instance, beginners can start with basic courses on budgeting and saving, while more experienced individuals might find value in specialized modules on stock market investments or real estate. Guidelines for selecting the right course include ensuring that the instructors are credible, checking peer reviews, and verifying that the content aligns with your current financial needs and future goals. Podcasts and YouTube channels present another dynamic way to stay updated on financial matters. These mediums are particularly effective for individuals who prefer bite-sized information delivered in engaging formats. Podcasts such as The Dave Ramsey Show or Choose Fi break down complex financial concepts into understandable segments, fostering consistent exposure to new ideas. YouTube channels like Graham Stephan or The Financial Diet provide visual and relatable explanations of financial strategies, which can be particularly beneficial for visual learners. Engaging with these resources regularly helps maintain a steady flow of updated knowledge and encourages continuous improvement. Financial blogs and forums are also pivotal in cultivating a well-rounded understanding of current financial trends and community-driven discussions. Websites like Investopedia, NerdWallet, and The Simple Dollar offer articles on the latest financial news, investment tips, and personal finance strategies. Participating in forums such as Reddit's r Personal Finance or Bogleheads allows for interaction with a community of like-minded individuals. This engagement not only provides diverse perspectives, but also fosters a supportive environment where financial challenges and successes can be shared. To make the most out of these platforms, it's advisable to follow guidelines like verifying information from multiple sources, engaging respectfully with other members, and staying proactive in discussions to maximize learning. Utilizing these resources effectively addresses different learning preferences and schedules. By integrating books and audiobooks into daily routines, individuals can gain in-depth insights at their convenience. Engaging in online courses and webinars ensures a structured approach to expanding knowledge, while podcasts and YouTube channels offer accessible, on-the-go learning. Participation in financial blogs and forums connects individuals to a broader community, enhancing awareness and encouraging mutual growth. As you navigate your financial journey, consider which resources align best with your lifestyle and learning preferences. Whether you're a young professional eager to establish a financial foundation, someone in midlife focused on securing retirement, or an individual dealing with financial anxiety, there are tailored options available to support continuous improvement. Establishing a habit of regular learning and staying informed will empower you to make better financial decisions, ultimately leading to a more secure and prosperous future. This chapter has underscored the critical role of knowledge in personal finance. By understanding income, expenses, and net worth, one gains a comprehensive view of their financial standing. Delving into the principles of budgeting ensures money is allocated wisely, addressing both immediate needs and long-term goals. Moreover, grasping concepts like the time value of money illustrates the benefits of early investing and consistent saving. These insights empower you to make decisions that foster financial stability and growth. Exploring various resources for ongoing financial education can further enhance your ability to navigate the complex financial landscape. Books, audiobooks, online courses, podcasts, YouTube channels, and financial forums offer diverse ways to deepen your understanding. Tailoring your learning approach to fit your lifestyle and preferences ensures continuous improvement. As you advance on your financial journey, staying informed and proactive will help you achieve better outcomes, ultimately leading to a more secure and prosperous future. Chapter 8. Planning for Retirement. Planning for retirement is essential to ensure a secure financial future. With the myriad of retirement plans available, it can feel overwhelming to choose the one that aligns best with your financial goals and lifestyle needs. Regardless of age or income level, everyone benefits from understanding the fundamentals of different retirement plans. This chapter offers a detailed look into how you can navigate and select the most suitable options, providing a strong foundation for your retirement strategy. In this chapter, you will discover valuable insights into various types of retirement plans, such as the 401k and individual retirement account, IRA. We will delve into key aspects like contribution limits and tax advantages associated with each plan. Additionally, you'll learn about evaluating different investment options within these plans, crucial for maximizing your savings. Finally, we will explore the importance of being aware of fees and expenses, which can significantly impact your investment returns over time. By the end of this chapter, you will be equipped with the knowledge needed to make informed decisions and take actionable steps towards a secure retirement. Choosing the right retirement plan. Selecting the most appropriate retirement plan that aligns with one's financial goals and lifestyle needs requires an understanding of various plan types. In the United States, two prevalent options are the 401k and individual retirement account, IRA. Each plan has unique benefits and potential downsides, primarily revolving around tax advantages. For instance, contributions to a traditional 401k are made with pre-tax dollars, which can lower your taxable income for the year, while Roth IRAs involve after-tax contributions, allowing tax-free withdrawals in retirement. Understanding these differences helps determine which plan best suits your current income situation and future tax expectations. Assessing contribution limits is another critical aspect of choosing the right retirement plan. 401k plans typically have higher contribution limits compared to IRAs. As of 2021, individuals can contribute up to $19,500 annually to a 401k plan, with an additional catch-up contribution of $6,500 for those aged 50 and above. In contrast, the maximum annual contribution to an IRA is $6,000, with a catch-up limit of $1,000. It's important to be aware of these limits not only to maximize savings, but also to avoid unnecessary taxes and penalties associated with exceeding them. For example, over-contributing to an IRA can result in a 6% excise tax on the excess amount each year it remains in the account. To make the most out of your retirement savings, evaluating investment options within plans is essential. A diverse portfolio often includes a mix of stocks, bonds, and mutual funds. Stocks provide the potential for high returns, but come with greater risk, making them suitable for those willing to accept volatility for higher growth opportunities. Bonds, on the other hand, offer more stable fixed income returns, which can be beneficial for risk-averse investors or those nearing retirement. Mutual funds pool resources from multiple investors to purchase a diversified portfolio of assets, thus spreading risk. Diversifying your investments can help mitigate losses during market downturns and enhance overall returns over time. Additionally, reviewing fees and expenses associated with retirement accounts is crucial, as these costs directly impact your potential returns. Fees may include management fees, administrative fees, and fund expense ratios. Over time, what might seem like small percentages can significantly erode your investment gains. For example, if two funds have similar performance, but one charges an annual fee of 1%, while the other charges 0.5%, the difference in returns over a few decades can be substantial. It is wise to compare different plans and understand all associated costs before committing. A guideline to consider when assessing contribution limits involves first determining your budget for retirement savings without affecting your current financial obligations. Then, plan contributions such that you do not exceed the allowed maximums for either 401k or IRA plans. It's also essential to consult with a financial advisor or use online tools to keep track of your contributions throughout the year to prevent any inadvertent overcontributions. When evaluating investment options, another helpful guideline is to periodically review and adjust your portfolio based on changes in your financial goals and market conditions. This ensures that your investment strategy remains aligned with your long-term objectives. For instance, younger professionals might prioritize high-growth stocks, while individuals closer to retirement may shift towards more stable income-generating assets. Finally, a guideline for reviewing fees and expenses is to aim for low-cost funds or accounts without compromising on the quality of investments. Tools and resources available online can help compare fees across different plans and funds, enabling you to choose the most cost-effective options. Additionally, being proactive in reading annual statements and fee disclosures will keep you informed about any changes that could affect your return on investment. Estimating your retirement needs. Planning for retirement is crucial for ensuring a secure financial future, and understanding how to calculate your financial requirements is an essential part of this process. One of the first steps in planning for retirement involves determining life expectancy and associated costs. This helps you figure out how long your savings need to last and account for variables such as healthcare and inflation. Life expectancy can be estimated using various tools and statistics based on factors like gender, lifestyle, and family health history. For instance, if current life expectancy trends, suggest that you might live until 85 or 90. Planning for those additional years is necessary. Estimating these numbers accurately means that you won't run out of money prematurely. Healthcare is a significant expenditure in retirement, with potential costs increasing as you age. Medical expenses could range from regular checkups to unforeseen surgeries, making it wise to factor these into your budget. Inflation, too, eats away at purchasing power. Hence, what seems adequate today may not suffice in the future. Estimating monthly income needs is another critical step. This involves identifying fixed expenses, like rent or mortgage payments, utilities, and insurance, which remain constant each month. Variable expenses, such as groceries, entertainment, travel, and hobbies, should also be considered. Creating a detailed list of these expenditures provides a realistic picture of your monthly cash flow requirements. It's worth noting that retirement often brings lifestyle changes. Some retirees find themselves spending more on leisure activities, while others may cut down on commuting costs. Anticipating these shifts helps ensure your income aligns with your retirement lifestyle. Modeling different scenarios is invaluable for preparing for uncertainties. By considering best case, worst case, and most likely scenarios, you get a clear view of how various factors might impact your finances. For example, what would happen if there was an economic downturn? What if you faced unexpected medical expenses? Conversely, how would a stable market affect your investments? Scenario modeling allows you to tweak your strategy accordingly, cultivating a mindset of preparedness rather than panic. Using online calculators and tools simplifies the estimation process. Numerous free and reliable calculators are available to help you gauge how much you need to save based on your current financial situation, future goals, and expected rate of return on investments. These tools often ask for inputs like your current age, retirement age, life expectancy, existing savings, and anticipated retirement expenses. Based on this data, they provide estimates of how much you need to save annually or monthly to achieve your retirement goals. Revisiting these estimates periodically is crucial, as personal circumstances and broader economic conditions change over time. Many calculators allow you to adjust variables and see how different factors impact your retirement savings, offering a flexible way to stay on track. When determining life expectancy and costs, remember the importance of regular reviews and updates based on any new developments in your life or the economy. Staying informed about healthcare trends and inflation forecasts can aid in making more accurate calculations. Regularly consulting with financial advisors can offer personalized insights tailored to your specific needs and circumstances, ensuring a comprehensive retirement plan. In estimating monthly income needs, consider setting up a detailed budget that separates fixed and variable expenses. Tools like spreadsheets or budgeting apps can help maintain an organized overview of your finances. Additionally, think about potential changes in spending patterns, perhaps by looking at current retirees' experiences or discussing with friends and family who have already retired. Understanding and anticipating lifestyle changes enables better planning and smoother transitions into retired life. For scenario modeling, leverage both conservative and aggressive assumptions to understand the full spectrum of possible outcomes. Create multiple models for different timelines and conditions, such as varying rates of return on investments or different healthcare cost projections. Alongside personal modeling, engage in discussions with peers or use resources from financial institutions that often publish scenario analyses and case studies. Utilizing online calculators and tools requires diligence in inputting accurate information to obtain reliable results. These tools can often connect directly to your financial accounts, providing real-time data integration, making it easier to keep track of progress. Periodic recalculations, maybe annually or semi-annually, will keep your retirement plan aligned with any changing circumstances. Remember, the goal is to establish a habit of regularly reviewing and updating your strategies to adapt to new information or changes in personal conditions. In this chapter, the focus has been on selecting the right retirement plan that aligns with your financial goals and lifestyle needs. We've explored the benefits and limitations of different types of plans, such as 401, KICAs, and IRAs, and discussed important factors like contribution limits, investment options, and associated fees. By understanding these elements, you can make informed decisions about where to invest your money for retirement and how to maximize your savings without incurring unnecessary taxes and penalties. Additionally, we provided guidelines for assessing your contributions, evaluating investment options, and reviewing fees effectively. Taking these steps ensures that your retirement plan remains aligned with your long-term objectives and adapts to changes in your life or economic conditions. Whether you're a young professional beginning to save or someone in midlife focusing on securing a stable future, these strategies offer a clear path to achieving a financially secure retirement. Regularly reviewing and adjusting your retirement plan based on new information and personal circumstances can help you stay on track towards your financial goals. Chapter 9. Real-world examples and inspirational stories. Real-world examples and personal stories have the power to inspire listeners on their journey to financial freedom. By sharing these narratives, readers can gain insights into various strategies and approaches that have led to both successes and failures. These stories not only motivate, but also provide practical lessons that can be applied in one's own financial planning. The chapter delves into real-life experiences, showcasing how individuals have navigated the complex landscape of finance through smart decisions, calculated risks, and sometimes learning from their mistakes. This chapter presents a collection of compelling case studies and inspirational tales from diverse financial backgrounds. Readers will explore the disciplined investing approach of the millionaire teacher, the entrepreneurial leaps taken by bold visionaries, and the strategic prowess of successful real estate investors. On the flip side, it also sheds light on cautionary tales such as the pitfalls of over-leveraging, the consequences of impulsive spending, and the challenges faced by those unprepared for retirement. Through these narratives, the chapter aims to equip readers with valuable lessons gleaned from real-world triumphs and setbacks, encouraging them to make informed decisions on their path to financial freedom. Case studies of financial success. The Millionaire Teacher is an inspiring example of how disciplined investing and financial literacy can lead to significant wealth accumulation. He began as a modest school teacher, understanding the importance of managing finances wisely. By focusing on smart asset allocation and early regular investment, he was able to build a substantial nest egg over time. His journey emphasizes the significance of starting investments early in life and maintaining a consistent approach. Additionally, the Millionaire Teacher's commitment to educating himself about various investment vehicles reinforced his financial decisions, showing that knowledge truly is power when it comes to building wealth. Next, let's explore the entrepreneurial journey. This story features an individual who made a bold decision to leave a stable corporate job and venture into entrepreneurship. Despite the risks involved, this person believed profoundly in their business idea and capabilities. The result? A profitable business generating multiple streams of income. Their success underlines the importance of calculated risks in the pursuit of financial dreams. By meticulously planning and leveraging their skills, they were able to overcome initial uncertainties. This narrative also serves as a reminder that self-belief and resilience play crucial roles in transforming visions into successful ventures. The real estate investor provides another compelling illustration of wealth creation through strategic real estate investments. This investor began with thorough market research, identifying promising locations and properties with potential for appreciation. Leveraging resources such as knowledgeable agents and advisors, they made informed decisions that minimized risks and maximized returns. Over time, these strategic moves allowed them to build a robust portfolio, demonstrating how real estate can be a powerful tool for wealth accumulation. This story highlights the value of patience and long-term thinking, and reminds us that building wealth often involves making well-informed choices and seeking expert guidance. Lastly, consider the expert investor, a retiree who successfully navigated the stock market using a simple yet effective strategy. This individual prioritized continuous learning, staying updated with market trends, and adapting strategies as needed. Their consistent approach allowed them to grow their investment steadily, even post-retirement. This example underscores the importance of personal adaptability and ongoing education in achieving financial success. The expert investor's journey serves as an encouraging tale, especially for those who believe it's too late to make wise financial decisions, proving that it's never too late to start investing and learning. Lessons learned from financial failures. In the journey towards financial freedom, learning from the mistakes of others can be invaluable. Real-world examples provide not only cautionary tales, but also lessons that can guide us to make better decisions. This section focuses on 4 stories that highlight common financial pitfalls and the critical lessons they offer. Our first story is about the over-leveraged investor. This individual was seduced by the promise of high returns through heavy borrowing. Initially, their investments seemed successful as they took out loans to finance multiple ventures. However, a sudden market downturn left them unable to cover their debts, leading to bankruptcy. This tale underscores the importance of understanding financial leverage and risk management. Borrowing to invest can amplify returns, but it also magnifies losses. It's crucial to assess your risk tolerance and have a well-thought-out strategy to manage debt effectively. Ensuring you have adequate savings and diversifying investments can mitigate the risks associated with leveraging. Next, we consider the lottery winner. Winning a large sum of money can seem like a dream come true, but for some, it quickly turns into a nightmare. One such winner received millions overnight, but within a few years, found themselves bankrupt. The sudden influx of wealth led to reckless spending, poor investments, and lack of financial planning. This example highlights the need for clear financial strategies, even when one comes into unexpected wealth. Financial education is crucial. Understanding basic principles of budgeting, saving, and investing can help preserve newfound wealth. Additionally, seeking advice from financial advisors can provide the necessary guidance to create a long-term plan and avoid impulsive decisions. The impulsive spender provides another important lesson. This individual's habit of emotional and impulsive spending created a cycle of chronic debt. From purchasing expensive items on a whim to using credit cards irresponsibly, their financial decisions were driven by immediate gratification rather than long-term stability. Eventually, this behavior led to significant debt and financial stress. The key takeaway here is the vital importance of strong spending habits and mindful financial decisions. Creating a budget and sticking to it, setting financial goals, and practicing self-discipline can prevent the accumulation of unmanageable debt. It's also helpful to differentiate between needs and wants, ensuring that spending aligns with one's financial objectives. Finally, we explore the story of the unprepared retiree. This individual faced severe financial distress in retirement due to inadequate planning. Throughout their working life, they failed to prioritize retirement savings and underestimated the amount needed to sustain their lifestyle post-retirement. As a result, they struggled to cover basic living expenses and medical costs. This scenario underscores the importance of long-term planning and proactive financial preparation. Starting to save for retirement early in one's career can leverage the power of compound interest. Utilizing retirement accounts like 401(k)s or IRAs and regularly contributing to them can create a substantial nest egg over time. Moreover, periodically reviewing and adjusting retirement plans based on changing circumstances ensures that goals remain achievable. Each of these stories brings to light common financial missteps that many individuals can easily fall into. The over-leveraged investor teaches us the dangers of excessive borrowing without proper risk assessment. To avoid this pitfall, it's crucial to diversify investments and keep debt levels manageable. The lottery winner reminds us that sudden wealth requires careful management and solid financial planning. Even if fortune strikes, maintaining financial discipline and seeking professional advice can safeguard against rapid loss of assets. Similarly, the impulsive spender's experience shows how detrimental emotional spending can be. Establishing a budget and adhering to it, alongside conscious decision-making, can foster financial health. Lastly, the unprepared retiree's plight emphasizes the necessity of preparing for the future. Beginning retirement savings early and reviewing plans regularly can ensure financial security in later years. This chapter emphasizes the influential power of real-world examples and personal stories in inspiring individuals on their path to financial freedom. Through the journeys of the millionaire teacher, entrepreneurial journey, real estate investor, and expert investor, readers can see firsthand how disciplined investing, strategic planning, and continuous learning can lead to significant wealth accumulation. Each story underscores various principles like early investment, calculated risks, market research, and adaptability, highlighting that financial success is achievable through informed and deliberate actions. The lessons from financial failures further solidify the importance of careful financial planning and decision-making. The over-leveraged investor, lottery winner, impulsive spender, and unprepared retiree provide cautionary tales about the dangers of excessive borrowing, lack of financial planning, emotional spending, and inadequate retirement savings. These narratives remind readers of the critical role that prudent financial habits, risk management, and long-term planning play in securing one's financial future. By learning from both successes and failures, readers are equipped with valuable insights to navigate their own financial journeys with confidence and foresight. Conclusion. As you reach the end of this journey, take a moment to reflect on the changes you've begun to implement. The path to financial freedom is not an overnight transformation, but rather a continuous evolution shaped by small yet significant steps. Remember that transitioning from a mindset of scarcity to one of abundance marks a powerful first step toward achieving your financial goals. As you look back on the chapters and lessons you've encountered, consider the mindset shifts that have taken place. Perhaps you've developed a deeper understanding of how your spending habits impact your long-term prosperity. Maybe you've realized the importance of viewing money as a tool, not just for survival, but for building a life that aligns with your dreams and values. These new habits and perspectives are the foundation upon which you'll build a secure financial future. Throughout this book, we've explored a wide array of strategies tailored to various stages of life and financial situations. By mastering essential budgeting skills, you've laid the groundwork for effective money management. Budgeting isn't just about limiting your spending. It's about prioritizing what truly matters to you and ensuring that your resources are allocated in ways that support your goals. When you set up a budget, you create a clear roadmap that can guide your financial decisions and prevent unnecessary stress. Understanding passive income generation has also been a crucial part of your financial education. Passive income represents the ultimate goal of financial independence, earning money while you're not actively working. Whether it's through investments in stocks, real estate, or side hustles that generate residual income, each opportunity to earn passively brings you closer to a stable and worry-free financial future. Learning about these avenues has equipped you with the tools to diversify your income streams and reduce reliance on a single source of earnings. Debt management was another pivotal topic covered in this book. For those grappling with overwhelming debt, we delved into actionable steps to regain control, such as negotiating with creditors and consolidating loans. Confronting and managing debt is a crucial aspect of financial health. It can seem daunting, but every payment made and every dollar saved contributes to reducing that burden, bringing you closer to financial stability and peace of mind. Planning for retirement, especially for those in midlife, has been emphasized as well. Understanding retirement accounts, calculating future needs, and investing appropriately ensure that you can retire comfortably and securely. It's never too early, or too late to start planning for retirement. The earlier you begin, the more time your investments have to grow. But even later in life, strategic adjustments can significantly impact your retirement readiness. Just like any skill, financial literacy evolves. Staying informed and continuously learning about personal finance is essential. The financial landscape is ever-changing, with new investment opportunities, tax laws, and economic conditions arising regularly. Commit to lifelong learning, explore new resources, stay updated on trends, and always be prepared to adjust your strategies as the market changes. Subscribing to financial news, attending seminars, or taking online courses can keep you informed and help you make well-informed decisions. Taking ownership of your financial future requires action. Setting specific goals and breaking them down into manageable steps transforms aspirations into achievements. Whether it's building an emergency fund, buying a home, or starting a business, clearly defined goals provide direction and motivation. Create a timeline with milestones to track your progress and celebrate the small victories along the way. Imagine waking up a year from now with a flourishing amount of savings and investments. By taking action today, whether it's creating a budget, starting an investment account, or simply setting a financial goal, you lay the groundwork for your financial independence. Small, consistent actions accumulate over time, leading to significant financial growth and security. It's important to remember that setbacks are a natural part of any journey. Economic downturns, unexpected expenses, or changes in personal circumstances can pose challenges. However, resilience and adaptability are key components of financial success. Learn from these experiences, adjust your strategies as needed, and continue moving forward. Each setback offers valuable lessons that contribute to your financial acumen. Inspiring stories of individuals who turned their financial lives around demonstrate that anyone, regardless of their starting point, can achieve financial freedom. These success stories illustrate the power of dedication, smart planning, and perseverance. Use them as motivation to drive your own efforts. Your journey will be unique, but the principles of financial discipline and continuous improvement remain universal. Building a supportive network can also enhance your financial journey. Surround yourself with like-minded individuals who share your goals and values. Engage in discussions about personal finance, exchange tips, and hold each other accountable. This community can provide encouragement, advice, and inspiration, making your journey less solitary and more collaborative. As you embark on this next chapter of your life, remember that financial wellness extends beyond numbers and accounts. It encompasses a holistic view of your well-being, including your mental and emotional health. Striving for financial stability should enhance your overall quality of life, allowing you to pursue passions, spend time with loved ones, and enjoy a sense of accomplishment and peace. The journey doesn't end here. It's an ongoing process that requires dedication, patience, and a proactive approach. Stay committed to your financial goals, continue learning, and don't hesitate to seek professional advice when needed. Financial planners, advisors, and mentors can offer valuable insights and personalized guidance to navigate complex financial decisions. In conclusion, the knowledge and strategies gained from this book serve as stepping stones toward a financially secure future. Embrace the shift from scarcity to abundance. Apply the lessons learned, and take proactive steps to safeguard and grow your wealth. Your commitment to financial literacy and empowerment will pave the way for a brighter, more secure future. Whether you're just starting your career, planning for retirement, or overcoming financial challenges, remember that the power to shape your financial destiny lies in your hands.